Right. So now coming to the integrated case study 5. SED and Associates, a firm of auditors, received an offer later dated 15 July 32 to conduct audit of BTM Limited, a listed company, engaged in the manufacturing of cement for the first time from 32-33 onwards. The audit was accepted by the firm on the basis of offer letter, designating it as engagement letter. The partners of the firm have not felt the necessity to keep documents to show that the firm has complied with the requirements of Section 141(3)(d) of the Companies Act 2013. Like 141(3). 141 is regarding the disqualifications of the company auditor, and 141(3)(d) not holding any security, interest, or indebtedness or guarantee. Right. CAE, engagement partner of SED Associates, is conducting the audit of the aforementioned company. The company was incurring losses since the last few years, and it has resulted in erosion of the substantial part of its net worth. It had negative working capital and was substantially debt-ridden. The company had only one plant located in Madhya Pradesh. The plant was found to be in good working condition during the course of audit. The majority of the fixed assets of the company were located at this very plant. The engagement partner was also informed during the audit that physical verification of PPE was carried out by the management during the year. However, the internal auditor had pointed out in one of its reports during the year that management did not physically verify PPE items. Having experience as an engagement partner in cement industry, he was of the view that the valuation of PPE was less than the value recorded in the books of account. However, no such assessment work was made during the audit. Impairment testing not done. During the year, the company defaulted in the repayment of loans to the bank, and the credit facilities of the company were classified as NPA by the concerned bank. On note, one note forming part of the notes to account and the financial statements on this matter presented for audit states as follows. The company has not provided for interest on the loan taken from the bank to the extent that the same has remained unpaid as the loan accounts have been classified as NPA by the lender bank, and the management is in the final stage of the settlement of the liability. Interest, if any, will be recorded in the books when it will be crystallized after settlement agreement with the lender bank. Considering the prevailing situation, future plans provided by the management in applying professional judgment, it has decided to include an EOM paragraph in the audit report related to going concern matters. It is felt that this matter is of such importance that it is fundamental to the user's understanding of the financial statement. The management has also included this matter in the notes to account. However, he has not felt the need for evaluation of future plans provided by the management. During the audit for 32-33, management was requested via letter dated 20th May 33 to provide all the information regarding contingent liabilities credential for logging the income tax portal, GST portal, and the other significant online portals. However, management has failed to provide such information, including the login credentials, despite the engagement partner request. Therefore, it was decided to sign the audit report on the basis of the information available up to the date of signing of the audit report. On the basis of the above scenario, you are required to answer the following MCQs. Okay. The case scenario describes the acceptance of the audit of the aforementioned company by SED and Associates. Which of the following statement is likely to be most appropriate in this regard? It was proper for the auditors to accept the audit of a company on the basis of an offer letter designated as engagement letter. There is no necessity to keep documents to show compliance with requirements of 141(3)(d). So long as there is no violation of this requirement, there is no necessity for this point. It is improper for the auditors to accept the audit of a company on the basis of offer letter designated as engagement letter. It is necessary to accept audit on the basis of a separate engagement letter. However, there is no necessity to keep documents showing compliance of 141(3)(d). So long there is no violation in respect of this requirement. Again, there is no necessity of this option. It is improper for the auditor to accept the audit of the company on the basis of an offer letter being designated as an engagement letter. It is necessary to accept the audit on the basis of a separate engagement letter. There is a necessity to keep documents to show compliance with the requirements of 141(3)(d). And it is proper for the auditor to accept the audit of a company on the basis of an offer letter designated as an engagement letter? No. So C would be the correct option. What should be the appropriate course of action for the auditors in respect of PPE, considering the situation described in respect of the above case scenario? The auditor should not attach much importance to the internal auditor observation as he has found the plant of the company to be in working condition with its major assets intact. However, it should be evaluated whether impairment testing has been performed considering the company's circumstances. So not attach much importance to internal auditor observation. I think we should not attach importance to this option. Auditor should determine what modifications to to resolve the inconsistency between internal auditor report and evidence obtained and its effect on the other aspects of audit. However, no evaluation of impairment testing is necessary considering the company's circumstances. No, rather impairment testing is necessary. The auditor should determine what modifications to audit procedure are necessary to resolve the inconsistency between the internal audit report and the evidence obtained. Further evaluation of impairment testing is necessary considering the company's circumstances. And the auditor should not attach much importance to the internal auditor observation. Further evaluation of impairment testing is not necessary. No. Right? Auditor should determine the modification and also do the impairment testing. The company has not recognized interest cost on its borrowings on loan accounts having turned NPA during the year under consideration. Which of the following is the most appropriate in this context? The policy followed by the management is in contravention of the accounting standards. The policy followed by the management is in accordance with the established norms due to the classification of loan account as NPA by the concerned bank. So the bank will recognize the interest on cash basis, but company, you don't need to accrue it. When a bank will recognize the income on NPA on the cash basis. As banks did not recognize interest income on NPA, mirror treatment is applicable to the company in question. Oh my God. The policy followed by the management is in accordance with the established norms as negotiations are underway with the banker. Interest would be recognized on NPA borrowing upon crystallization of final settlement with the borrower. No. The policy followed by the management is in contravention of the guidelines issued by the RBI. RBI has issued guidelines for the bank, not for the company. So the policy followed by the management is in contravention of the applicable accounting standards to be followed by the company. The auditor has decided to include an EOM paragraph in the audit report relating to going concern. Which of the following statement is true? Right, so going concern, if there is any issue, do you put it in the EOM? No, we put it under the MUGC, material uncertainty related to going concern. So EOM can be included in the audit report depending upon the auditor's judgment and evaluation of management's plan without maintaining documentation. No. EOM can be included in the audit report because going concern matter is fundamental to the user's understanding. No separate evaluation. No. If adequate disclosure about the uncertainty is made in the financial statements, the auditor will express an unmodified opinion and the report will include a separate section called as the MUGC. So unmodified with MUGC. And if adequate disclosure is made, the auditor will give a modified opinion and include a separate section on MUGC. No, it is unmodified with MUGC. Considering the matter of not providing information regarding contingent liabilities, including the login credentials by the company as described, which of the following is most appropriate? Auditor should express unmodified opinion, asambhav. Auditor should request management again to provide such information and must determine, if not by hook then by crook, whether it is possible to perform alternative audit procedures to obtain evidence. In case of failure to obtain evidence, implication for audit report should be considered. Auditor should take written representation from management stating that all liabilities have been reflected in accordance with 580 and unmodified opinion should be expressed. The auditor's responsibility is fulfilled on commenting appropriately regarding non-furnishing of required information by management regarding disputed statutory dues under clause 7B of the CAR. Right, so there they are giving it a different dimension, right? Clause 7B says disputed statutory dues, the amount involved and the forum where the dispute is pending. Right, so here what you do, if not main procedure, alternative procedure. That is also not possible, 705. Right, so the correct option over there would be B. Right, so we've completed with the case study number 5. Okay.